Alright guys, so in the previous video we discussed that we are going to move in journals, and what we discussed really was what are assets, liabilities and capital, and how the accounting system works. Okay, and now we are going to move on into accounting cycle, and today we are going to do the first thing, journal entries. Okay, before I move on, I need to specify this thing that journal entries are classified into general journal and specific journal. You might be wondering, why do I have journal over here and I have journal here? So these are two different things. So the difference between this journal and this journal is that you have to write details, and you will be classifying only those things into this journal which are not classified in these accounts or in these journals, right? So this journal just have debit and credit and does not really interfere with whether it's purchase of goods, whether it's purchase of non-current assets, or we are selling on cash or on credit. Okay, so purchase return is something when we buy goods on credit terms, we will have trade payables, and we only post the entries once. So remember this thing, in this journal we are posting the entries twice, in this we are posting once. Okay, we will just write the name, we will get into that later, but just giving a brief introduction of what it is. Same things goes when the purchase return, when the trade payable return the goods, we will write the name of the trade payable over here. Okay, so when we sell the things, and if we are selling on cash, it will not go in sales journal, but instead it will go in cash book. And if we are buying on credit, then it will go into sales journal, and we will write the name of trade receivable in the sales journal. Alright, so moving on to sales return, it's something similar to purchase return, but it's other way around. If we are selling goods and if we are receiving the goods from the customer, then we will be writing the name of trade receivable and reminding that in these all transaction, or in this also for the journal entry, we are going to record the transaction once only. For cash book, we are going to have double effect when we will move on into ledger, but for now we are just going to post it once. Journal entry, we will be posting it twice. Okay, so what happened in journal is, in this journal we are also going to write the narrative why this is something that is not classified, or the transaction is not going into these accounts and it's going to journal. Coming back to cash book is more like if we are paying something, or if we are receiving something in cash, then we will have, or then we will use cash book. Or if we are depreciating something, or if we are doing something that does not relate cash, or it's not going into these journals, it will go into general journal. I think I have emphasized enough on this, so let's move on and get some examples. So in this video I will be doing journal, this one, and in the next video I will be doing these all. Okay, so moving on to the entries, I need to mention, I have mentioned couple of entries from 1st January. I have chosen the order in the sequence so it's easier to understand. So when we open a small business, or when we are opening the business, usually we invest the capital into business, then we buy equipment, then we pay rent, then we buy inventory, then we open a real business, then we start selling the goods, then we buy more inventory, and we will have the opportunity to buy on credit also. In this case, I already mentioned it's cash, because usually when we open the business, it's hard to get on goods on credit. So then we will buy some goods on cash also, because we will have a credit limit, and then we will again sell goods. I will also highlight on why it's 80% and why it's 50%, and what does it have to do in the next few videos. Okay, so then the owner will take out some cash for the personal use. We will open a drawing account for that later on. Okay, so moving on to journal entries, this is how we are going to post it. And then, okay, let's look at this example. So 1st January, invested the capital into business. Always I have mentioned that assets are going to be debit. Okay, it exclude the cash book, because cash book will have debit and credit because when we receive money it's debit, and when we give out the money it's credit. So liabilities will be credit. Okay, and then we will have capital will also be credit. Okay, so if you want to know the other way around also, I have used this thing what is called more like lies. I'm not sure I can do it here or not. Okay, so this is, let's say this is debit side, and then we have a credit side. Okay, so it's this. Okay, let's maybe we can put star. Okay, for liabilities it's credit, L is for liabilities, A is for asset, and then we have I, which is for income. Income is also credit. So this will help when we are making the transaction. And then in last we have expenses. Expenses are debit. So if you see, this is a name, Alice, it's easier to remember this way. And if you say that Alice is having a smile, it's not really a smile. If you make it like this, maybe it becomes a smile. If we are seeing the screen in the horizontal way, then maybe it looks like a smile. So it goes like this, it is supposed to go like this. Okay, so if you can memorize this pattern and name, then I think it will be a lot easier to post the entries. But just understand the basic concept that cash can be debit or credit, capital is always credit. Okay, on 1st January we bought the things, and then we debit cash and we credit capital because it is always credit. Why cash is debit? Because the business is receiving money. So this I have written this detail because this is what we are going in to do in general journal, but I am doing this right now, so I won't be writing this with others. This was just a simple example. Okay, however, if we are writing this in specific journal, this entry is going into cash book, not into journal because the business is receiving the cash. Moving on to second entry, that is bought equipments for the business for 5,000 on cash. Then equipments are debit, we are receiving. When we buy equipment, we receive the equipment and we give the cash. Okay, so when we give cash, we are giving out the cash, that is credit, and we are receiving the equipments, that will be debit. Okay, so this is the basically format of journal. We will have date, detail, and detail. Usually sometimes we don't have detail because it depends on you how you want to present things. I'm just having detail, so it's easier to classify things whether it's debit or credit, and I don't have to put the space couple of times. So I just feel it's like time saving. So moving on, this will be debit and this will be 5,000 credit. Then moving on to rent, 2nd January, again we paid the rent, so we are giving out the cash. In this case, when we are giving out the cash, it's credit, and when we are getting something in return, that is rent. Okay, this will be actually rent expense, in this case expense. So expense is always debit. If we look at this thing, then expense is debit, it's falling under the category of debit, right? So it will be debit, and it's 1,000 in this case. Then moving on to the next entry, that is 3rd January, bought inventory for 10,000 on cash, one item for $7. Okay, I will explain this thing why I have mentioned $1 for $7 later, and this thing also why it's important to know its value. So for now we are going to post just one entry, and that will be on 3rd January. We will write the date under the date column, we will write the account name. It can be either inventory or it can be either purchase. Then we will credit cash. In this case we bought the goods on cash, so it is 10,000 debit and 10,000 debit and 10,000 credit. Okay, so moving on to the 4th January, we have 50%, sold inventory, so it's mean we sold 50% of 10,000, that is 5,000 for 12,000. So we sold an inventory for 12,000 sales. Okay, sales is an income for the business, so if it's an income it is going to be credit. Okay, so sales, where is it, this one. All right, so sales is credit. Okay, this is credit. If we see, this is credit for this. So this is the transaction for sales, and cash, we are receiving the cash, that mean our cash account is increasing, that is why it's debit. Okay, so the reason why it is 50% and that why we are having mentioned here the value of each item is because whenever we sell goods we have to classify how much inventory is going out. Therefore we will be having four transaction here, but I am not mentioning it right now because the reason is for IGCSE it does not require, it requires for higher level. Okay, so if we are selling 50% of inventory we have to make another transaction below this. So I have to make two columns here, so which will be purchase, or it can be inventory. Okay, inventory will be credit and the other account will be cost of goods sold. Why cost of goods sold? Because this is something we have in the income statement. So in this case we are not going to write 12,000, but we are going to write 5,000 instead. Why 5,000? Because that is 50% of 10,000, right? We have to calculate. So this is one way to mention things, how we can mention in the statement or transaction, or we need to know how much goods we sold. So let's say we sold 100 goods, 100 goods for this, and each item was $10. Okay, if it's, then it should be 120. Okay, easier, right? 1020. Yeah. Okay, so one item was $10, then we can classify that we sold this much goods and we bought this much goods. For how much goods we bought in this case should be another case scenario. Okay, but this is a simple concept of what we should be doing in actual accounts. But if you are doing just IGCSE, then this entry you can just ignore and delete it. Okay, so moving on to the next inventory or next transaction, that is on 5th January. 5th January, if you look here, we bought some inventory on credit, that is 8,000. So in this case we are buying on credit, right? We are not buying on cash. If we are buying on cash it will go into cash book. So if it's credit it means it's a trade payable, we will be paying it in the future, and if it's a trade payable it will be a liability, therefore it is credit. Okay, purchase is an expense, that's why it is debit. Okay, and this is credit because it's a current liability. 8,000 debit and 8,000 credit, the amount cannot be different. Okay, I hope that's clear so far. If you have any doubt so far you can list down in the comments. I will try to clear that as I can. If I can, I can help you in any way and as possible. So this is the next entry, we bought the goods on the cash. So in this case you can see the difference between this entry and this entry. So if what happens if we buy on credit, our credit is going to be trade payable. If we buy on cash, okay, if we are buying on cash, then it's going to be on cash book. Okay, in this case I have just written cash. So we receive the goods, that is debit. Purchase is an expense. Cash, we are giving out the cash instantly, and that is decreasing our bank account or cash account, and it's credit. So in this case 2000 debit, 2000 credit. Moving on to January 7th, we sold goods 80%. Again I will be not doing this in this video, I will be doing this in another video, so we can have more deep concept of what or how we are supposed to post the entries for cost of goods sold. So we sold the goods for 19,000 and 5,000 was on cash and the rest entry was on credit. That means the total goods we sold was for 19,000, 5,000 for cash. It means we received 5,000, okay, and 14,000 will be on credit. So it means I'm going to post cash first, okay. So cash will be debit and trade and sales will be credit. Then again I'm going to post another entry that will be trade receivable, that will be 14,000. I have to minus this from this because the total amount of goods is this, and I sold 5,000 for cash and the rest is on credit terms, okay. Rest is on credit. So sales again is an income, it will be credit. Trade receivable is a current asset, that's why it's debit. Then we have drawings. So drawings is something we have to open an account when a business or owner or take out the cash for the personal use, okay. It's important to know if the owner is taking the dividend or the owner is taking out the money for the personal use. If he is taking out the dividend, then we are going to open the account with the name of dividend, okay. But in this case he is taking out the drawing, so I think we don't have to mention this thing, so we can just delete it and let it be drawings. So drawings are debit and cash is credit. Why cash is credit? Because cash is reducing. We are giving the cash, the business is giving the cash to the owner and the owner is receiving the cash. And that's all for this tutorial. We will be moving into specific journal into next tutorial. So maybe hope that's clear so far. If you have anything to let me know, please list down in the comments below. Thanks for watching.